Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, June 13th, and you, of course, are tuned in to On Trend, the show designed to keep you on the right side of the trend. And we're going to look at that long-term uptrend in the S&P 500 and the breakouts in SPY and IWM. We'll look at small caps in detail, as well as biotechs, Chinese stocks, and stocks that are on trend. So we're going to start off with the S&P 500 because time and time again, I come back to this, that the S&P 500 is the most important market benchmark that you should be watching. You can take all the breadth indicators you want, all the indexes you want, all the ratio charts, all the Fed indicators, blah, 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 junk bonds and all that. But really, when it comes down to the stock market, this S&P 500 chart is the one we need to watch every single day for our clues. And if we look at this, and it's also important that we get our biases out of the way, and we all get these biases. I'm guilty of it. You know, we see a lot of negative things out there, and that influences us. But when you look at this S&P 500 chart, and you just take it for what it is, well, I mean, look at this. You know, we've got a 52-week high, not only a 52-week high, but an all-time high there in late April, early May. All right, that's like less than 2 months ago. That's like 6 weeks ago. All right, and then we had this decline here that was 7%. And sure, it felt pretty bad at 27.50, but it was just 7% after a 26% advance. So it was a pretty normal pullback. We found support near this low, which I think is more coincidence than anything. We did dip below the 200-day, but as I showed last week, the 200-day is notorious for whipsaws, and we got back above the 200-day. And now we've had basically a 5.3% advance in 5 days. And then we stalled basically for 2 to 3 days now. But as far as the bigger trend is concerned, which I used to basically set my bias, my trading bias, if you will, you can see the 20-day was always above the 200-day. So that was in play. The bulk of the evidence turned bullish in mid-February, and it never turned bearish in late May or in early June. So everything was still pointing to a bullish environment. All right, yeah, I did mention, I was getting a bit negative, and I said we got a 6.5% advance in 7 days, and we got a 6% advance in 6 days, and now we've got a 5% advance in 5 days. And that is looking kind of questionable as far as are we between a rock and a hard place, because we're short-term overbought, but yet we got breakouts working. And I think we got to take it for what it is. Right now we have a long-term uptrend, and we've reversed the short-term uptrend, as I'll show with these wedge breakouts. It's vitally important that we keep an open mind and we realize that the stock market can do anything at any given time. And you got to think, what is the last thing you're expecting? Well, you better think about it, because the last thing you're expecting could actually happen, so you better get ready for it. Like if the last thing you expect is for small caps to start leading and the S&P 500 to move to a new high, well, you better get ready for it. I'm not saying it's going to happen, but you got to think the odds favor that happening right now, for the simple reason that we had this wedge correction here. Then we had the 4-day reversal. You can see there was a gap down, a 2-day stall, and then a gap up and a big advance. And then we got the wedge breakout. And now we've stalled for basically 3 days. So that's kind of alleviated some of the overbought conditions that we had. But a lot of people watch the S&P 500, and a lot of people watch the 50-day and the 200-day. And I think as long as you're above that 50-day, the chances of becoming overbought and remaining overbought are above average, as you're holding strong, and that means we could continue higher before we get a pullback in the short-term trend. Now, as far as, the health of the short-term trend, well, yeah, this breakout zone is maybe the first area to watch. We get back to that 2,800 level on the S&P and 280 on SPY. If you break those levels, then you have a chance of a bigger trend change. But short term, as long as that 50-day holds, we got to keep a bullish bias on the market, short term and, of course, long term. We look at QQQ. You can see that we have the breakout as well. And I'd also point out that, look at that, it was darkest before the dawn. We had this huge decline, the biggest decline of the move. Well, maybe this one was a little bigger, but it's clearly a big decline, and that marked the bottom. That's just the way it happens sometimes. You get this huge move on the upside or the downside. I mean, if you look at this gain here, you had a big gain in early March, and that led to a pullback. All right, so watch out when you get an outsized gain after an extended move. So here we had an extended move, and then we got an outsized loss there, and that led to the bottom. And of course, we got the channel breakout there, and it is holding. Now we look at small caps. Small caps are also in bull mode. Why is that? Well, because the S&P 500 is bullish, and that means the broader market environment is still bullish. And my breadth table is still 5 of 9 indicators are on active bullish signals. Now, small caps are a bit finicky. You can see that, we had this breakout here, and it looks like they were going to lead in April, but then they crushed in May with a sharp decline. But we also got that 4 candlestick reversal with a gap down, 2 indecisive days, and a gap surge on turnaround Tuesday. So this is the active signal here, this breakout here. And as long as it holds, so as long as 148 holds, I would be bullish on IWM as well. So many of us have heard the story that small caps are the canary in the coal mine. But, when it comes to the S&P 500 and the broader market, the relative performance of small caps is not that big of a deal. All right, I think it's something we really need to ignore and focus on the bigger picture with the S&P 500. And you can break it down by sectors if you want. But what I'm talking about here is, okay, I've got the S&P 500 in the upper window, and it's moving up. I got the Russell 2000, and it's moving up. Hasn't yet cleared this high, so it is underperforming. And then I've got the ratio of the two in the lower window. And you can see here that, small caps have not been performing well. They didn't perform well from the middle of 2010 until the latter part of 2014. They were just flat. They weren't outperforming. They weren't underperforming. And then you look here, and you get like a multi-year low in the price relative in late 2014. That shows that small caps are lagging. That's that red vertical line. And then you get a bounce in the market. All right, then we get this period about a year later when the ratio moves to another 52-week low as it breaks down in the latter part of 2015 and early 2016. And then we had a serious bottom and a serious rally in the stock market. So here we are again. We fast forward. We get a multi-year low in this ratio, which means relative to large caps, small caps are seriously underperforming. Oh my God, the market's going to crash here in the latter part of 2018. And shortly after that 52-week low in the price relative, we got the big bounce from late December until late April. So here we are again. We've got a 52-week low, a multi-year low in the price relative. And so does that mean the market's going to crater? Well, looking at the previous signals, it doesn't. All right. Does it mean small caps are lagging? Well, yes, it does. It means large caps are leading small caps. But it doesn't mean the market's going to crater. Well, no, it doesn't, because small caps represent less than 10% of the overall market. But if you look at what's happened previously, when you hit multi-year lows in the price relative, you got a bounce. So that might be foreshadowing a bounce in small caps. So biotechs are looking interesting as they firm here over the last 3 to 4 weeks or so. So the first chart here is IBB, and that's the NASDAQ Biotechnology ETF. And you can see from the holdings that it is dominated by large caps. The top 10 holdings account for over 50% of the ETF. And I'll look at 9 of those 10. I'm not going to look at Celgene because it's being acquired by Bristol Myers. But when I look at this chart, I see one of these classic setups that really makes me watch closely for a potential breakout and reversal. And the setup I'm talking about is you basically get a sharp advance, which we got from late December until the latter part of February, the end of February. And then we kind of stalled around and we had that breakdown in April. Okay, so now we're in a downtrend where we've broken a support level and we got lower lows and lower highs. But what catches my eye is we've formed a falling wedge. And so I don't look at falling wedges when you're hitting 52-week lows because that's a long-term downtrend, and I'm not looking for reversals in long-term downtrends. Similarly, I don't look at rising wedges when you're hitting 52-week highs because that's a long-term uptrend, and I don't look for reversals, but I do look for wedges when you're above the prior low, which is December, and when you've retraced 50 to 62% of the prior advance. You can see with the retracement tool there, 50 to 62% or 61.8%. Now, there's no magic there in 61.8%. Charles Dow said the retracement goes from 1/3 to 2/3, and Fibonacci says 38.2% to 61.8%. And when it comes to indexes and retracements and stuff, I think, basically 1/3 to 2/3 is your general idea. So that's why I use the Fibonacci retracements tool because it's getting close. And so when we get into this zone, we've retraced around half, a little over half, then that's like you've had basically 2 steps forward and 1 step backward. And if you're going to get an uptrend going here, then we look for a breakout. And you can see some resistance from these mid to late May highs. And if we get a breakout there, I think that's going to be a bullish development for Biotech, IBB. Now I'm seeing similar action in XBI. And if you look at the top holdings for XBI, you can see it's a different ETF. Sure, it's got biotech stocks, but you can see the top 10 stocks account for less than 20% of the ETF. And you can see the only 2 big names I see there are Celgene and Gilead. The rest of them are smaller biotechs. It's a much broader based biotech ETF that is not heavily concentrated in the large caps. And it's got a similar picture here on the chart where you have a much bigger, stronger advance here. Look at that move from late December to early April. And then you had the decline, and you're firming near the 50% retracement. So it's been 2 big steps forward, 1 step backward. We got some sideways price action here. So that shows you that buyers and sellers have come in equilibrium. We got some indecision, and that indecision can sometimes give way to a reversal. And if we get a breakout there at 84, I think that would be bullish. Now, which one is better? Well, it's a bit hard to say, but I think I favor XBI over IBB. And what I've got down here is the XBI-IBB ratio. And you can see that XBI did outperform when you had the advance from December until March. It has underperformed April, May, June, but very slightly, I think. So watch for an upturn in this ratio to signal that smaller biotechs are outperforming larger biotechs. But I think I would favor XBI on any kind of a breakout. Now, I want to return to China. I spoke about China a couple weeks ago, and we've gotten a bounce in Chinese stocks, but we had a pullback yesterday, and I think they're trading around flat, the Chinese indexes today, which hasn't opened yet in the U.S., but Chinese stocks have been trading for quite a few hours already as I speak. But this first ETF here is the China 300 A-share ETF. And then the second one I'm going to show is the FXI, the iShares China Large Cap ETF. And I want to show you the difference in these two. So I did a little Google. I just Googled FXI ETF Holdings, and I went to the iShares website because that's the fund family. And so they will have the most up-to-date information, I think, for the holdings. If there's any changes, that'll be reflected here first. And if you go down to the holdings section, you can see which stocks are in this ETF. And there we can see it's dominated by large caps. There we have Tencent, China Construction, Ping Insurance, China Mobile, Konok, which is the oil company in China, and China Petroleum and Chemical. And there you can see the holdings on the right-hand side, the percentage weighting. So there's about 62 stocks in this ETF, and again, it is mostly large caps. Now, in contrast, if we go over to the 300 China A-shares ETF and we look at the holdings, we can scroll down, and I downloaded these, but there's over 300 stocks in this ETF. And you can see the weightings are a bit high at the top, but they go down quite quickly. And you can see once you get to the bottom, the weightings are like 1.5%. So this is a much broader based ETF of Chinese stocks. So it's going to reflect the performance of small and mid caps in China. So I'll compare these two in a minute. But when I look at the Chinese A-shares ETF, the 300, it's doing what it's supposed to do as far as a bullish setup is concerned. You know, first you have this big surge, January to March, and you're entitled to a pullback. I mean, you went from 21.5 to 30. That's like a 30%, more than a 30% surge. And then you had a sharp decline, but you came back to broken resistance here, and there's that 50 to 62% retracement. So you had a normal retracement. We didn't get a nice wedge or a pattern to work off of, but you can see we started firming in here with some sideways price action. And then we got the bounce on Friday, Monday, and Tuesday, and then a little bit of weakness on Wednesday there. But now we have a resistance level right there, just above 21. And if we can get a breakout there, I think that's going to be bullish for the ASHR, the Chinese ETF for small and mid caps. Now, if we look at large caps here, we can see a different picture. It's clearly not as positive. You can see that we have the big advance, but look at the decline. Okay, we went below the 200-day. We went below the 61.8% retracement. We went below the breakout zone. So we totally overshot on this decline. But we did manage to firm in the 40, 42 area for a couple of weeks. And we got that surge and then the sharp pullback yesterday. So if we can get a breakout above that mid-May high there, I think that's going to be a bullish development for FXI. So now let's look at both of them. And I was thinking, well, maybe we can get a tell here based on the performance of one to another. But, I'm not sure if there's any information here to be gleaned. I mean, come on, China is a controlled economy. It's a command economy. So if the government is going to juice things up, these are probably both going to go. And I think if they both go, I would think the ASHR would outperform. At least it's outperforming now. So on this chart, I've got FXI in the top window, and you can see it's below the 200-day. And then you can see ASHR is above the 200-day. So it's holding up better on this pullback here. And then if we look at the ratio of the two, ASHR to FXI, this ratio falls when ASHR underperforms. And you can see it underperformed from June to December. And both of these decline. And then we can see it turned up sharply in February and March. And that's when ASHR advanced and outperformed. And it's holding these lows here from March and May. So it's holding up much better, this ratio. So that means ASHR is holding up better. And then you can see the ratio turning up here. So it's outperforming. So if I had to pick one of the two, it would be ASHR as far as which one would lead. But we need to get the breakout there, as I said, just above 27 on ASHR and just above 42 on FXI. So the name of this show is On Trend, and now I want to show you some stocks that I think are on trend and have some pullbacks and breakouts working. And before I show some of these, I want to show you the method behind the madness for selecting these. And I basically use two criteria. I use the Arun up and Arun down indicators, and I use the RSI range. So first up, I want to show Arun up and Arun down. And what I've got here is I've got the 65-day price channel indicator here, and I've got 65-day Arun up and Arun down. And basically what happens when Arun up hits 100, as it did in early November, that means you have a 65-day high, which of course happens when you move above the upper channel of a 65-day price channel, the upper line. So you can see here in December, we moved below that lower line. So that was a 65-day low, and correspondingly, Arun down, 65-day Arun down hit 100. Then we had a 65-day high in February with Arun up hitting 100. And there you can see we just edged above that upper line of the price channel. And then if you look now in June, we almost hit 90 in Arun down, but not quite. You can see we did not breach the lower line of the price channel with that dip below 60 there. So the price channel was holding. Now there's an easier way to view the price channels. I've just got the default setting here. But if you scroll down and you look at the price channels here, you can see there's the price channels overlay. And I changed the color here to pink, and I changed it from auto there to area. And I'm going to put opacity at 3.3, and that's going to make it somewhat transparent. And sometimes that's a bit easier to read there. And there you can see. So basically what the price channel is telling you is the upper line is a 65-day high, the lower line is a 65-day low, and the middle line is the average of the two. So in order to show you the other indicator, RSI range, I'm going to go to the Stock Charts ACP, the advanced charting platform, very intuitive and interactive charting. And what I'm going to do is set up this chart how I need it. And you can see here, we've got the indicators on the left. This is a default with RSI in the top and MACD below with volume. But I want RSI at the bottom. So I'm going to drag this indicator down below. And I don't want MACD. So I'm going to click on that MACD title there, and I will get the settings there, and I can delete it. And I don't want volume either. So I'm going to click the little gear icon for the settings, and I'm going to delete the volume. And to tell you the truth, I really don't want well, I can leave the 200-day and the 50. Those are nice indicators. And for type, I'm going to move to high-low close bars. And so when I get that setting the way I like it, I can click to close that window and enlarge the chart. Now up at the top right, I'm going to click the scrunch icon there. And now when I use the mouse wheel, you can see I can see a longer time frame or a shorter time frame. So I'm going to do Live Nation, which is LYV, to pull up that chart. And what I really like about this is I can just drag this window here to make it bigger. So I've got RSI, and I need to get it at 65 periods. So I'm going to click on that RSI name there, and I'm going to change the period setting to 65 and click Update. All right, so now I'm looking for RSI values to be between 45 and 55, basically. And I can't get any lines on there yet. They're going to put these on soon. But basically, I think we moved below 45 here in March and then above 55 here. But this gives you a lot more detail on the movement of the RSI line. So now I'm going to switch over to a sharp chart. So here I've got Live Nation on a sharp chart, and I placed RSI behind the price window there. And we can see I've got a red line at 45 and a green line there at 55. And what I want to see is I want to see RSI moving above 55 to show upside momentum. And I want to see it not go below 45 to show limited downside momentum. And we didn't go below 45 there in December, and we resumed the upside momentum there in February. And if you look down on this lower window, you can see in more detail because I've blown up RSI there. So basically, when you're moving above 55, you're showing upside momentum over a 3-month period. And as long as you hold above 45, you don't have much downside momentum. And then there's a rune indicator. And you can see here a rune down hit 100 in December. And so that reset the 65-day period. And what do I mean by that? Well, if you scroll up to the chart here, what we have here is there's that reset, okay, in December when we had a 65-day low. And so once we had that reset there, then I had to change things. And so I had to start counting 65 days from this period. So once we got to 65 days and a rune up had hit 100 and a rune down did not hit 100, which means we had a 65-day high, but not a 65-day low, and RSI did not go below 45, and RSI moved above 55, as it did there. So we had upside momentum, we had a 65-day high, we did not show downside momentum, so then it made my scan list. And this is a scan list just to show you some strong uptrends, and you monitor this list, or I monitor this list. And you can see now we've got a pullback, and we're still in bull mode, and we've got a breakout in Live Nation. So that's why I use this list. I make my list of stocks and strong uptrends, monitor it on a regular basis, and look for these kind of setups, this falling wedge and breakout. So I'm going to write about this scan and do some back tests for you in a System Trader article next week. And I've also updated the Arch Charts chart list, which is available for subscribers. Here's another example with Omnicom. There you can see there's a 65-day period when you have RSI holding above 45 and moving above 55, and you have a rune up hitting 100 and a rune down did not hit 100. So once you go 65 days with those two characteristics, it goes into bull mode. And then you wait for whatever setup you might be looking for. Maybe it's this little triangle here. Now we have a wedge and we have a breakout in Omnicom. All right, so that concludes this edition of On Trend. Thanks very much for tuning in and have a great day.
Market direction is the single most important thing all investors need to know. Get the advice you need by joining dozens of elite money managers and financial experts, including Steve Forbes, Paul Merriman, Tom McClellan, and Keith Fitzgerald at the Money Show Seattle June 15th and 16th. You'll hear real-time market analysis and learn which stocks, bonds, funds, and commodities you should buy and sell to build a safer, more profitable portfolio. Claim your free pass at seattlemoneyshow.com.